Welcome back, students and scholars. In this episode, we are learning one of the most important practical areas of ASC 230, the direct method and the indirect method for operating cash flows. Both methods are allowed under US GAAP and both should arrive at the same destination, net cash from operating activities. The difference is the route. The direct method shows gross cash receipts and payments, while the indirect method starts with net income and reconciles it to operating cash. Think of it like two roads to the same exam answer. One road shows every turn, the other starts from the final profit number and works backward to cash. And yes, accounting loves giving us two valid ways to reach one number because one method was clearly not enough entertainment. Here is our learning path for this video. First, we will understand the presentation choice and identify exactly which section of the cash flow statement is affected. Second, we will study the direct method, where operating cash receipts and payments are shown directly. Third, we will study the indirect method, where net income is adjusted for non-cash items and working capital changes. Fourth, we will cover the reconciliation requirement and the common exam traps. Keep one thing clear from the beginning. Direct and indirect method discussion is mainly about the operating activities section. Investing and financing activities do not suddenly become direct or indirect. They continue to be presented based on the nature of the cash flows. ASC 230 permits two presentations for operating activities. Under the direct method, the entity lists gross cash receipts from customers and gross cash payments to suppliers, employees, taxing authorities, and similar parties. Under the indirect method, the entity begins with net income and adjusts it for non-cash charges, non-cash gains, and working capital changes. This is why the direct method feels like a cash register view, while the indirect method feels like a reconciliation schedule. The important point is that the choice affects only operating activities. The purchase of equipment is still investing. Issuing shares is still financing. Repaying debt principal is still financing. The operating section gets the method choice, the other sections keep their normal classification logic. Now let us compare preference versus practice. Conceptually, the FASB has preferred the direct method because it gives users clearer information about actual operating cash receipts and payments. A user can see cash collected from customers, cash paid to suppliers, cash paid for interest, and cash paid for taxes. That is very useful. But in practice, preparers often use the indirect method because it is easier to prepare from existing accounting records. Many accounting systems are built around accrual income, not around a perfectly tagged cash receipt and cash payment database. So the direct method may be more transparent, but the indirect method is more common. In real life, accountants often respect theory, then quietly choose the method that does not ruin the month-end close. Let us start with the direct method logic. The direct method does not begin with net income, it directly presents cash collected and cash paid in major operating categories. Cash collected may include collections from customers, interest received, dividends received, and other operating receipts. Cash paid may include payments to suppliers, employees, lenders for interest, and tax authorities for income taxes. The key idea is that accrual-based income statement amounts must be converted into cash basis amounts. Sales are not always equal to cash collected. Expenses are not always equal to cash paid. The direct method forces us to ask a very practical question. How much cash actually moved during the period? Under the direct method, ASC 230 expects major classes of operating cash receipts and payments to be shown. Cash receipts include amounts collected from customers, interest received, dividends received were classified as operating, and other operating receipts. Cash payments include payments to suppliers, employees, interest, income taxes, and other operating payments. Notice the benefit for users. They can see the operating cash engine clearly. They do not just see a reconciliation from profit. They see the actual cash inflow and outflow categories. This is why the direct method is often more understandable for students and financial statement users, even though it may require more detailed preparation work behind the scenes. Now let us study the customer cash formula. We start with sales revenue from the income statement. Then we add beginning accounts receivable, because cash collected during the current period may include receivables that existed at the start of the period. Then we deduct ending accounts receivable, because those sales have been recorded but not yet collected in cash. If there are write-offs, we deduct them separately because write-offs reduce receivables but do not produce cash. So the result is cash collected from customers. A simple shortcut is this: sales plus decrease in net accounts receivable, or sales minus increase in net accounts receivable, with write-offs handled carefully. This is where many students lose marks because they treat accounts receivable like magic. It is not magic, it is timing. Next, we convert cost of goods sold into cash paid to suppliers. We start with cost of goods sold, but COGS alone is not supplier cash paid. We add ending inventory because purchases may have been made but not yet sold. We deduct beginning inventory because those goods were already on hand from the prior period and did not require current period cash. Then we add beginning accounts payable because old payables may have been paid during the current period. Finally, we deduct ending accounts payable because those purchases have not yet been paid in cash. The memory point is powerful. Supplier cash paid is affected by both inventory movement and accounts payable movement. If someone says cash paid to suppliers equals COGS, please do not panic. Just calmly introduce them to the balance sheet. For other operating expenses, the direct method again converts accrual expense into cash paid. Start with the operating expense from the income statement. Add ending prepaid expenses because cash may have been paid in advance for future benefits. Add beginning accrued expenses because prior period obligations may have been paid in the current period. Then deduct non-cash expenses such as depreciation and amortization because they reduced income but did not consume cash in the current period. The formula is not about memorizing signs blindly. It is about asking what the accrual number includes, what cash timing effects exist, and what non-cash charges must be removed. Once that logic is clear, the formula becomes much less frightening. Now we move to the indirect method. The indirect method starts with net income from the income statement and adjusts that number to arrive at net cash from operating activities. First, we add back non-cash expenses such as depreciation and amortization because they reduced net income but did not use cash. Second, we adjust for working capital changes because current assets and current liabilities explain timing differences between accrual income and operating cash. Third, we remove gains and losses related to investing or financing items, especially gains and losses from asset sales. The indirect method is basically a bridge from accrual profit to cash reality. Net income says, here is what accounting recognized. The indirect method says, thank you, now let us ask what cash actually did. Working capital adjustments are the heart of the indirect method. If a current asset increases, deducted from net income because cash was used to build that asset or revenue was recognized before cash collection. If a current asset decreases, added back because cash was collected or recovered from an earlier balance. For current liabilities, the direction is generally the same as the cash flow impact. If a current liability increases, add it back because an expense was recognized but not yet paid. If a current liability decreases, deduct it because cash was paid for a prior obligation. The memory rule is simple. Current assets move opposite to the cash flow impact while current liabilities move in the same direction. This rule is small, but it can save many exam marks. Non-cash items are also adjusted under the indirect method. Depreciation is added back because it reduces net income without requiring a current period cash outflow. Amortization follows the same idea for intangible assets. Deferred taxes may require adjustment because tax expense recognized in accounting income may not equal cash taxes paid. Equity method income also needs care. If an entity records equity method income but receives a smaller dividend in cash, the excess income is non-cash from an operating cash flow perspective and must be adjusted. The main idea is not that these items are unimportant. They are important for accrual accounting, but the statement of cash flows asks a different question. Did cash actually move? Now let us handle one of the most common traps: gains and losses on asset sales. Suppose an entity sells equipment and records a gain. That gain increased net income, but the full cash proceeds from selling the equipment are reported in investing activities. If we leave the gain inside operating cash flow and also report the full proceeds in investing, we double count part of the cash effect. So under the indirect method, gains are deducted from net income. Losses are added back because they reduced net income, but the cash proceeds still belong in investing activities. The rule is simple. Remove the gain or loss from operating cash flow and report the full cash proceeds in investing. Gains and losses are like guests who walked into the wrong section. Politely escort them out. Finally, remember the reconciliation requirement. If a for-profit entity uses the direct method to present operating cash flows, it must also provide a reconciliation from net income to net cash from operating activities. In other words, the entity still has to provide indirect style support. This reconciliation starts with net income, adds back non-cash items, adjusts for working capital changes, and arrives at the same operating cash flow number shown under the direct method. If the direct method number and the reconciliation number do not agree, there is an error. There is a not-for-profit exception under ASC 958, but for ordinary for-profit entities under ASC 230, do not forget this requirement. Choosing direct method does not mean saying goodbye to reconciliation. Reconciliation still sends a calendar invite. Let us close with the key takeaways. The direct method shows gross operating cash classes such as cash collected from customers and cash paid to suppliers, employees, lenders for interest, and tax authorities. The indirect method starts with net income and adjusts for non-cash items, working capital changes, and gains or losses that belong outside operating cash flow. Working capital is the bridge between accrual profit and operating cash performance. Current assets and current liabilities explain timing, and timing is everything in cash flow reporting. If this video helped you, please like it, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can continue building serious free education. In the next video, we will prepare a full ASC 230 statement of cash flows from comparative financial statements and additional information. Bring your formula cards because now the cash flow map becomes a complete practical build.